Morning, good afternoon, good evening, Sir Michael. So today our group would like to present our presentation on the topic ledger accounts and journal entries to record issue of new shares, bonus issues, and right issues. So the first one is issue of new shares, application, allotments, and calls. So what is issue of new shares? The issue of new shares comprise an offer, acceptance, and payment. The application for shares is the offer to the company, and when it advised of the allotment, that constitutes the acceptance. The invitation is issued as a prospectus or the offer. Investor or applicants apply and send in money due on application or the acceptance. Applications. This scenario covers the journal entries and ledger accounts required when the shares are paid for in full at the application stage. In turn, this covers two different possibilities: shares issued at par or nominal or face value, and share issued at a premium or for more than the nominal value. In the following examples, we will assume that the issue is fully subscribed. That is, the number of applications for shares equal the number of shares offered. Okay, so this is the example for application. The next one is allotments. Allotments is the process by which companies pass on new shares to shareholders who may themselves be new or existing shareholders. With a share allotment, the shares are created and issued by the company to the people who become the company's shareholders. And this is one of the example for allotments. And the last one is calls. So for this part, it is divided into two categories. There are calls in advance and calls in arrears. So calls in advance is if a company accepts the amount against the call or calls which are not made yet. The amount so received in advance is called calls in advance. It may also happen in case of partial or pro rata allotment of shares when the company retains excess amount received on the application of shares beyond the allotment money. And if a shareholder is not able to pay the call amount due on allotment or on any calls according to the term, the amount that becomes due is called calls in arrears. We may transfer or not transfer the arrear amount on account of allotment. This Okay, this is the example for the calls part.
The next subtopic is subscription of issues of shares for cash. Subscription of issues means to be subscribed. An investor either buys or agrees to purchase a set number of shares during an offering. Subscriptions can be viewed and make orders to purchase soon-to-be-issued shares from their brokerage firms. There are three types of subscriptions. The first one is full subscription, which means all shares offered for sales are equal with the number of shares which it received. Applications are the same. For example, a company issued 500,000 0.5 euro ordinary shares at par, payable in full on application. Application received is amounted to 500,000. The next there's under subscription, which means the number of shares company offers to the public is more than the number of shares for which it received the application. Transactions will be the same as full subscription, but the quantity of shares will be less than the offer quantity. While offer subscriptions means that the number of shares company offers to the public is less than the number of shares for which it received the application. In result, some applications will be rejected and there's unsuccessful applications. For example, in under subscription is when 500,000 with 1 euro ordinary shares are offered at par, but only 400 applicants. The value will be 400,000 euro as 100 shares have not been applied. While offer subscriptions is when 500,000 at 0.5 euro ordinary shares are offered, but application received amounted to 600,000. In solution, 600 shares applied for 0.5 euro is 300,000 euro, while 100 shares are refunded, which is 50,000 euro.
Now is issue of shares payable in installments, fully or over. This is when shares are issued payable by installments. The amount due for each installment may be debited to the shareholders' account. However, by doing so, no distinction will be made between the various installments. What installments? An installment is part of the full amount payable for shares. It relates to each portion of the total amount due. Therefore, there are as many installments as there are parts to be paid in full of one or more shares. This is the example of the installments. On 30 September 2016, Jacaranda issued a prospectus calling for application for 600,000 ordinary shares at an issue price of $3, payable $150 on application and $150 on allotment. By the closing date of 31 October 2016, the company had received the following application money: from applicants for 500,000 shares, from applicants for 120,000 shares, $750,000, 360,000 on 15 November. It was decided to allot to applicants who paid more than the application money the number of shares applied for, and to applicants who paid only the application money 480,000 shares. Application money was refunded to 1,000 unsuccessfully applicants. The Constitution gives the director the power to apply excess application money to allotment. All other allotment money was received by 31 December 2016. These are the necessary ledger account to record the above transaction.
So the next one is issues of new shares, right issues. So what is right issue? A rights issue is an invitation to existing shareholders to purchase additional new shares in the company. This type of issue gives existing shareholders securities called rights. With the rights, the shareholder can purchase new shares at a discount to the market price on a stated future date. The company is giving shareholders a chance to increase their exposure to the stock at a discount price. Next is features of a right issues. Companies undertake a rights issue when they need cash for various objectives. The process enables the company to raise money without incurring underwriting fees. Next, a writing issue gives preferential treatment to existing shareholders, where they are given the right, not obligation, to purchase shares at a lower price on or before a specified date. Next is existing shareholders also enjoy the right to trade with other interested market participants until the date at which the new shares can be purchased. The rights are traded in similar way as normal equity shares. Next point is the number of additional shares that can be purchased by the shareholders is usually in proportion to their existing shareholding. And last one is existing shareholders can also choose to ignore the rights. However, if they do not purchase additional shares, then their existing shareholding will be diluted post-issue of additional shares. Reasons for rights issues. When a company is planning an expansion of its operations, it may require a huge amount of capital. Instead of opting for debt, they may like to go for equity to avoid fixed payments of interest. To raise equal capital, a right issues may be faster way to achieve the objective. A project where debt or loan funding may not be available or suitable or expensive usually makes a company raise capital through a right issue. Next point is companies looking to improve their debt to equity ratio or looking to buy a new company may opt for funding via the same route. And the last one is sometimes troubled companies may issue shares to pay off debt in order to improve their financial health. Next, this is the example of rights issues. So on 31 December 2017, a right issue of ordinary shares was made at premium of $0.515 per share on the basis of 2 ordinary shares for every 5 held on the date. The issue was fully subscribed. First, we need to find the par value, premium, and market value. The par value, which is 0.25, premium of 0.15, and market value of 0.4. The current number of shares is 500,000 divided by 0.25, which is 2 million shares. And number of share for right issue is 2 million times 2 per 5 equals to 800 shares. And this is the journal entries. The first account is cash, which is on debit side, and ordinary shares and share premium are on the credit side of the journal entry.
The next one is bonus issue. A bonus issue, also known as a scrip issue or a capitalization issue, is an offer of free additional shares to existing shareholders. Bonus issues are given to shareholders when companies are short of cash and shareholders expect a regular income. Shareholders may sell the bonus shares and meet their liquidity needs. Bonus shares may also be issued to restructure companies' reserves. Issuing bonus shares does not involve cash flow. It increases the company's share capital but not its net asset. The example problem of bonus issue is if a company declares 1 for 2 bonus shares, that would mean that an existing shareholders will get 2 additional shares for 1 existing shares. Suppose a shareholders hold 2,000 shares of the company. When the company issues bonus shares, he will receive 1,000 bonus shares because 2,000 times 1/2 equals to 1,000. There are some advantages and disadvantages of bonus issue. The first advantage is it increases the issued share capital of the company. The next one is the company is perceived as being bigger than it really is, making it more attractive to investors. And the last one is increasing the number of outstanding shares decreases the stock price, making the stock more affordable for retail investors. The first disadvantages is it could result in a decline in the dividends per share in the future, which shareholders may not view favorably. And the next one is issuing bonus share take more money from the cash reserve than issuing dividends does.
Thank you for listening to our presentation.